Hi everyone. I'm back with something new. I want to share something with you. Welcome to my YouTube channel, Life with the Russells. And yeah, I am introducing some other stuff to you, different from my current content. This is something different. I want to share. I want to share this person with you. He's a very good, he's so knowledgeable about life insurance, and I listen to him a lot. He's a part of our team.
Hey, everybody, this is Ian Prukner, Senior National Sales Director from Michigan, and we're here to talk today about mastering the life insurance product at the kitchen table, being able to do a tremendous job for our clients, a tremendous job for our company, and a tremendous job for you as the agent, being able to increase your production and do the right thing for the client across the kitchen table 100% of the time. And what I've found in traveling the country is people are hungry for more and more knowledge about exactly how our products work. And so I'm going to share with you some very, very specific information about how our products compete in the marketplace and some information that's not widely known in a lot of areas in the company, but I think is important that people know because it gives our product a competitive advantage in the marketplace. It puts the consumer in a much better place at end of term. They have way more flexibility than other products that are out there. And I think that you're going to get a lot of value out of this program. So we're going to talk about a number of things. Number one is how that product works and how to position it. The second thing that we're going to talk a lot about is best practices at the kitchen table, different presentations you can do to convey the value of going with Primerica Life or NBL in New York to help the client be put in the best position. Okay, so there's really 4 steps to this process. I'm a process person. Discretion is the enemy of duplication. And so when you get a process down that you can teach to other people very quickly, you can have an army of people out there helping clients across the kitchen table successfully and making sure they're doing the best job possible. The client is really well educated on the benefits of having life insurance through the Primerica companies. So I want you to think about the 4 steps. The first step in the process at the kitchen table is you've got to identify what sort of scenario this client is in. There's really 5 potential scenarios. When you're sitting at a kitchen table, you're having a life insurance conversation. There's only 5 scenarios that this client could potentially be in. The first is they're single, no kids, they don't have any life insurance. Okay, the second scenario is they don't have any life insurance, but they're married, have kids, or both. The third scenario is the only life insurance that they carry is group insurance through work, employer-provided insurance. The fourth scenario is they have cash value insurance of some sort. And the fifth scenario is they already have term insurance through another carrier. Okay, and then I'm going to teach you some questions that you can ask to help position the transaction, right? To help the client get in the frame of mind of moving forward and taking action today. Because if they don't take action, you're not really helping them, right? Thinking about having life insurance doesn't actually help them have life insurance, right? We got to help them to take the step to go forward to protect their family. Okay, then we're going to go through a common close that I teach all my people that's really an informational close. It's not a close or a tactic. It's teaching the client the process that they're going to go through so that they feel comfortable. Most people are afraid to move forward simply because they're afraid of the unexpected. They don't know exactly what the process is going to be like. And so that close is going to help to explain that process. And then lastly, we'll talk about some of the most common objections and helping people to calm their concerns and take action on the thing that is best for them to do. All right. So the very first scenario that we're going to talk about is single people with no life insurance. A lot of people would tell you, Ian, single people, what do they need life insurance for? They're not married, they don't have kids. But I'm going to make a case to you why single people should have life insurance, especially through the Primerica companies, because this product is so unique, has so many benefits to it that are going to put these clients in a lot better position down the road. So we're going to role play this, okay? That's the best way to learn, is to watch exactly what I do, learn it word for word, practice drawing the presentations. And then when you find the scenario real time at the kitchen table, you're prepared. You know exactly what to do. Skills pay the bills. So skill up, right? Get these things down, get them exact, have them in your repertoire. And when you come across these scenarios at the kitchen table, you're going to be able to use them. You're going to be able to use them fluently, and people are going to go forward with you at a lot higher rate than they have been before. So let's take a look at how the schematic of this process is going to work. Okay. So we're going to, once we've identified what presentation we're giving, we're obviously going to give the presentation associated with what sort of scenario this client is in. That's going to be different. Once that presentation is complete, then we're going to ask the closing questions, okay? So the closing questions are going to be the same every time. Once we've asked the closing questions, we're going to go ahead and move into the close and getting the application started. That process is the same every time. So what I need you to understand is the scenario is going to give you a different presentation, but after the presentation's done, you go right into the closing questions and then right into the close and taking the app. All right, so let's start with our first scenario, which is a single person with no life insurance. So a lot of our clients that are single will look at that and think, I'm not really sure I need life insurance, but I believe very strongly that people do need life insurance that are single for a number of reasons. So here's the conversation that I'm going to have with a client. So we're talking to Bob. Bob is single. He doesn't have any children. And I'm going to ask Bob a question. I'm going to say, Bob, Have you ever considered having life insurance? Sometimes they do. A lot of times they say, I've thought about it, but most of the time they're saying, well, no, I haven't really thought about it. I'm not married. I don't have kids. I say, well, Bob, do you mind if I give you just a couple-minute education on why I think it's important for single people to have life insurance? Generally, he's going to say yes. And that's what I'm doing. I'm getting little yeses along the way to a big yes, right? So the presentation that I'm going to use for single people with no life insurance goes as follows. So, Bob, the cost of life insurance is really based on two things, okay? What do you think those two things are, Bob? And I let Bob answer, right? Because I learned a long time ago that when you say it, the prospect outs every word. When they say it, it's 100% true. So I want to get the client, the prospect, involved in the process so they understand what we're doing. An educated consumer is the best consumer when it comes to dealing with Primerica Life Insurance Companies, MBL in New York, okay? So the cost, Bob, is based on two things. What do you think those two things are? And I let them think about it. Generally, they get them right. If they don't get them right, I help them along. But the first answer is age, right, Bob? Of course it's age, right? The older you are, the more expensive it's going to get. Bob, let me ask you a question. Will you ever be younger in the future than you are today? And Bob's going to say, well, of course not, right? Okay, so you're guaranteed to be getting older. The second factor in determining the cost of your life insurance is your health. So, Bob, let me ask you a question. Have you ever heard of people who get healthier and healthier and healthier as life goes on? No, of course not, right? The way God made our bodies, we do not get healthier and healthier as life goes on. We become less and less healthy. So if we know that this commodity, this product of life insurance is going to cost more in the future, absolutely going to cost more in the future because we're getting older and we're getting less and less healthy, would it make sense to get it now while it's as cheap as possible? Or does it make sense to wait and be guaranteed to pay much, much more potentially in the future? Of course, it would make sense to lock it in at the lowest rate. The second benefit, Bob, is something called a living benefit. Most people think the worst thing that could happen to them financially would be to pass away prematurely. But Bob, in your situation, you're not married, you don't have kids, way, way, way worse than that would be for you to get very, very, very sick, but not pass away immediately, right? Because you'd have skyrocketing medical bills. We all know health insurance doesn't pay for everything. You know, most people who have terminal cancer, let's say, they're not going from radiation to chemotherapy to work, right? So their bills are skyrocketing because of medical expenses. Their income is going down because they're not working as much or at all, right? So if your expenses go up and your income goes down, Bob, is that a good or a bad thing? That's a bad thing, right? Well, if something were to happen to you, God forbid, where you were diagnosed with a terminal illness, and there's some different things. You got to read the contract, exactly what qualifies, how it works. They got to get a note from it. They've got to be seen by a physician, et cetera. Okay, but Bob, if you were able to have a benefit where you had access to, let's say, $250,000 of money that you could get if, God forbid, you were diagnosed with that terminal illness, and you could use that money to maybe take your family on a vacation or seek alternative medical treatment that your insurance didn't pay for, or any number of things. If you had access to that $250,000, would that help you in that situation that, God forbid, something like that happened? Of course it would. Do you have access to $250,000 right now in any other way? No, you don't, right? So that's a reason why you would want this, a benefit to having that. Bob, the third reason that I believe that single people should have life insurance is there to protect the people we love and care about in case of a premature death. And I ask him, I say, Bob, let me ask you a question. Is there anybody in your life that you love and care about greatly that struggles financially right now? And Bob will answer. Everybody has somebody like that. And I'd say, Bob, if God forbid something were to happen to you, and 2 or 3 weeks later, a check arrived in their mailbox and it paid off their mortgage, or it sent their kids to school, or it helped them actually be able to retire, how would they feel about you having done that for them? It would change their life, right?
Yep.
Of course, they'd feel incredible. Okay, Bob, would we want something to stop you from being able to help your family like that? Of course not, right? So that's why it makes sense for you to do this. All right, let's go ahead and go forward. So that's scenario one. That's single people with no life insurance. Let's talk about scenario number two. Scenario number two is married people or people with kids that have no life insurance. Okay, so you're at the kitchen table, you're talking to Bob and Susan. They're married, they've got 2 little kids running around in the background, and you're talking about life insurance. You say, by the way, Bob, who do you guys have your life insurance through? And they reply, well, we don't have any life insurance. So this is exactly what I do. I kind of sit back a little bit. I say, Bob, you have no life insurance? And I let them react. Most people understand this is something they need to be doing. So that reaction that they give me is going to tell me kind of where they're at. And here's the presentation I give to them. I say, Bob, when I meet people that are married with kids like you are that don't have life insurance, it's generally for one of 3 reasons. Okay. The first reason is they kind of know they need to do it. See, I'm shaking my head. Yes, right. They kind of know they need to do it. They just really haven't gotten around to getting it done. Okay. The second reason is sometimes people are concerned about the cost. They really haven't looked into it much. They're just afraid of another expense. Okay. Now, the third reason, Bob, and I'm sure this isn't you. Okay. I'll just tell you that right up front. But believe it or not, every once in a while, Bob, I meet people who just don't care about what happens to their family. Now, Obviously, that's not you, right? We're sitting here, you have a great family. So Bob, if that's not you, which of the first two reasons would you say is the primary reason that you don't have this right now? And I let them answer. And if it's they know they need to get it done, I say, well, we're going to help solve that tonight. Okay, we're going to get that done for you. If it's a cost issue, I'll ask them another question. I'll say, well, what do you think it would cost for you to have that? Okay, and I just let them put out some ballpark, and then I go into the closing questions, which we're going to get to. So that's it for the presentation. Very quick, 3 bullet points, right? No, cost, and don't care. Okay, but listen to me on this. You can't say I meet people who don't care about their family. The first thing you say is, believe it or not, and I know this isn't you, you make sure you let them know it's not them, okay? I'm sure this isn't you, but every once in a while, I meet people who just don't care, okay, about what happens in their family. So get that off the table, and they'll pick from one of the first two, and then you can address that concern, ask some closing questions, and get them to move forward. The third scenario is people with group insurance, okay? People with group insurance. So again, when I'm talking to them about life insurance on the kitchen table, I'm asking them, well, who does your life insurance? They say, well, I have it through work. I say, well, that's great, but who does your life insurance? I say, well, I just told you I have it through work. So you don't have any private insurance at all? And I ask them with a little bit of question, and I let them react to me. And I want to see where they are emotionally in that. I say, well, is it all right if I give you a couple of minute education on group insurance? And what we always recommend, and what most experts recommend, is whatever you can get for free from work, take. Free is good. Get as much as possible. Okay, but whatever your family would need, you want to make sure that you own privately. Okay, and I'm going to explain to you why that is. Is that okay if I share that with you for a couple of minutes?
Great. Yes.
Okay, so Bob and Susan, really the first reason why we want to have life insurance outside of work is the trend. Okay, every headline you read, every news story you see today, does it show employees jumping for joy outside of their corporate offices and the news anchor saying, employees ecstatic, benefits getting better and better, employees paying less but getting more, everybody's toasting champagne glasses outside of the work? Is that what it shows? They say, no, of course that doesn't show that, right? It's the exact opposite. Employees shouldering more and more of the cost of their own benefits. Employee benefits going away. Employees going contracts, so they don't have to be given health benefits and different benefits. The trend in employee benefits is that employees are shouldering more of the burden, more of the cost, and getting less and less value. Would you agree with that, Bob and Susan? Of course you would. Okay, so when it comes to something as serious as protecting our family and making sure that when we need it, that coverage is there, I don't think it makes much sense to put that in the hands of our employer and bet against a very clear and obvious trend. You would agree with that statement, right? Of course you would. Great. The second thing is you need to be working there in order to be eligible. Most of the time, there are some policies that have portability riders on them or different features. They tend to get very, very expensive, and they're very, very few and far between. By and large, most of the time, the employee must be employed there to be eligible for their employee benefits, right? And what I say to them is, I say this, in today's day and age, 30 and out is gone, right? Most people are going from job to job. They get downsized. There's just no loyalty anymore with companies. You'd agree with that, right?
Yes.
So, what are the odds of you staying at your job forever, never getting a better offer, never starting your own business, never retiring, and just one day dropping dead, right? I mean, it's potential, but it's a small potential. And if the policy is enforced, your employer's chosen to keep it, and that happens, I have no doubt in my mind that you would be paid. The problem is there's a lot of reasons you wouldn't be paid, like you left the job, you went somewhere else that didn't have it, et cetera. So when it comes to something as important as protecting your family's financial future, we don't want to have that tied to our continuous performance at a job we may not like, may not be able to do, or we get a better offer. You'd agree that it would make sense for you to have control of that rather than tying it to your employment status, right? Of course you would. Great.
Of course.
The third issue is generally you've got to be on active payroll. So not only do you need to be working there, okay, but you need to be actively employed, okay? In a lot of cases, if you cannot be on a long-term disability or other things, these benefits shut down. So a lot of people don't understand is, something happens, they get very hurt, they end up in the hospital, they're taking extended amounts of time off work, maybe they're sick, and inadvertently, no cause of their own, they switch from an active payroll status to a disability status, and many times that coverage goes away with their active payroll status. They didn't know, they thought they were all set. When it comes time to pay that claim can be denied a lot of times because they're not on an active payroll. So again, what are the odds of us working at the same place forever, never getting a better offer, never going contract, never retiring, and not getting sick or hurt prior to passing away? Again, so now we're really whittling down the use of this, which is generally why it's free, right? You've heard the saying, you get what you pay for. Okay, so free is great. Take as much as you can. But we want to make sure that we have control. We don't want to be having our family sitting in a hospital potentially someday, looking at a time frame and saying, if they go this much longer, we're not going to have an insurance benefit, right? We want to make sure that your family has everything they need to make sure that you have what you need to get better to fight through it, and not be looking at timeframes on a work insurance policy. You would agree with that, right? Of course you would. The fourth benefit is a living benefit. Okay. And on our product, there's a living benefit that allows you to take 40% up to $250,000 out while you are alive. If, God forbid, you were diagnosed with a terminal illness, you had 6 months or less left to live, there's some other factors there that you need to look at, policy size and other things, okay? But that you can take out while you're alive, that you could take to get medical treatment, maybe some different avant-garde medical treatment, things that are not readily available. Maybe your insurance wouldn't pay for them, pay your bills, pay your mortgage off, maybe take your family on a vacation. And if, God forbid, you ever found yourself in a situation where that happened, and you had access to a benefit of $250,000, okay, maybe less, maybe a little more, depending on the structure of your policy. But if you had that, that would be helpful in that situation. You would agree with that, right? Well, your work policy does not have that. There's no living benefit associated with your group insurance at work. Okay, so that's another reason why it makes sense. So whatever you're getting for free, great. But anything that you need, we need to get privately. Now you understand why, right? Okay, very good, great. Let's go ahead and get that process started. Okay, the fourth scenario is somebody with cash value insurance. Now, y'all are absolutely great at this. I mean, we have a strong heritage and lineage of being able to really help people understand why cash value insurance isn't good for them. So we're not going to spend a lot of time on this, but I draw a little bit of a graphic here. So I see somebody has cash value insurance. The best thing to do is to get them to get their policy and to just show them in their policy, right? Did you know this? Did you know you're not going to get both? Did you know you have to borrow your own money? Did you know, right? And just go ahead and show them in their policy. But in the event that they don't have their policy readily accessible, here's the presentation I use. So I say, great. So let me give you a couple-minute tutorial, Bob, if it would be okay, on how your cash value insurance policy works, okay? Because I want you to make sure you understand it, because I believe that when you understand it, you're not going to want to continue with it, and you're going to want to do something different, okay? So cash value policies are very, very expensive. They're many, many times more expensive generally than an equal face amount on term insurance, okay? So it's very expensive, and the money's going in two sides, okay? Side one is an insurance benefit. Let's just say $100,000 face value, okay? The other side is a cash value, okay? So there's two sides. Money's going to insurance and then a cash value, okay? There's three problems with the cash value account that the insurance salesperson who sold this to you conveniently forgot to mention, okay? So I'm going to share those with you. I just want you to think them through to see if you understand them. The first problem with the account is for the first 2 to 5 years, every dollar that goes into the cash value, okay, is taken. The insurance company takes it. It's not available. So let's imagine, and this is not a bank account, okay? This is your cash value account. But let's imagine, let's use an analogy, so to speak, of going into a bank, okay? Because you put the money in here, into this account, all right? So you walk into a bank, you name the bank. Where do you bank? And I ask them, where do you bank at? They say, I bank here, I bank there. I use that bank. I say, Bob, if you walked into, ABC Bank, and you open an account with them, and they say, Bob, we're so thankful that you're doing business with us. We're looking forward to a lifelong relationship with you. But just so you're aware, we won't plan on seeing you for the next 3 to 5 years. Because if you come back here to get your money, there won't be any here. We're going to take all of it, every cent that you deposit with us in the next 3 to 5 years. So we'll see you in about 5 years. We look forward to talking to you then. Yeah. If the banker told you that, would you ever open that bank account? And Bob said, well, of course I would. I said, well, unfortunately, you just did when you bought this product, okay? So the second issue is the only way you can get money out of this without surrendering your policy is to loan it to yourself at interest, okay?
That's crazy.
So whose money is in this account, Bob?
Yours.
It's your money, right?
Yes.
Okay. Have you ever heard of having to pay interest
and
your own money?
No.
Probably not, right? Okay. So imagine we walk back into ABC Bank and they said, Bob, Susan, man, we're so glad to have you as clients. This is going to be a great relationship. But if you ever come back here for $1 of this money, we're going to charge you interest till you pay us back. Would you ever open that bank account, Bob?
I don't know.
Susan, would you ever open that account? No, of course you wouldn't. Unfortunately, you just did when you bought this. Okay. But it gets worse than that. Okay. And the third issue is really worse than both. And that is when you die, you get the choice, not you passed away, but your family gets a choice of the insurance or the cash value. They don't get both. The only exception to that is on a variable policy, universal policy, where they have an option B death benefit. Okay, it's an extra expense. They are out there. It's rare. They're paying even more than the already huge, gigantic premium they're paying now. Okay, but by and large, most do not have a cash value plus insurance. Okay, so you get the choice of the insurance or the cash value. Okay, so at age 100, generally the insurance and cash value are supposed to be equal, right? So the insurance would be worth $100,000. The cash value would be worth $100,000 at age 100, right? So let's pretend you died at age 80. Okay, it's not going to quite be 80,000 because of interest, other things, but let's just use the round number of 80,000 in cash value and $100,000 death benefit. So you pass away, your family gets a choice of the 100,000 or the 80,000. So which would they pick? Well, they'd pick the 100, right? And at first glance, Bob and Susan, most people would say, well, what's wrong with that? I bought a $100,000 policy. They paid my family $100,000. Let's watch the math here. So the insurance company pays out the $100,000 death benefit, but they get to keep the $80,000 in cash. So they pay out 100, but then they take over your 80K. So how much does the insurance company in this example have to pay? The insurance company paid 20K, their own money, and offset the rest of the death benefit with the cash value they were able to keep. So you paid for how much insurance, Bob? You paid for 100. But how much insurance money did you actually get? In this example, you got 20. So Bob, you're paying for two things, insurance and cash, but at any one given time, you only get one thing. So you understand why you don't want to have this? Bob and Susan, of course you do. Great. Let's go ahead and get you started. Okay. The last scenario is they already have term insurance. We're going to spend some time on this. We're going to get very, very detailed. So I hope that you have a pen and paper ready. I hope you watch this as many times as it takes you to get it, because once you get it, you're going to be a very, very powerful force out there in the marketplace, and you're going to be doing a lot of good. Okay. So let's talk term insurance basics. Okay. So here's time, here's dollars. Let's look at $1 million term policy, not with us, not with another, just any term policy anywhere. $1 million face amount for easy math. Okay, so here's time, here's 10 years, 20 years, 30 years, 40 years. So let's say you buy a 20-year, $1 million term, doesn't matter what company it's through. For all practice.
That's what we do, guys. We sell term insurance. All right, so he's going to explain to you why term insurance is the better choice, okay?
Practical intents and purposes, this is how that policy works. $1 million for 20 years, 20 years from now, it ends. Technically, it doesn't just end, and this is where you need to know your stuff. Okay, there's three choices at the end of virtually all term insurance. Okay, choice one is you can renew. Virtually all term insurance is renewable. Renew is keep the same policy, but at a different rate. The problem with renewals is most renewals range anywhere from 8 to sometimes 45 times the original cost. So they're paying $1,000 a year annual premium. 20 years from now, it renews, it's $12,000 a year, or $20,000 a year, or $40,000 a year in some cases, right? So the renewal is generally not a feasible option because the multiple of the premium has gone up to a point where people cannot pay it, okay? So it's an option, but it's not viable virtually ever, and so nobody does it. The second option is you can do what's called a conversion or an exchange. A conversion or an exchange would be to switch from the current product to some future product, okay? Term insurance outside of Primerica is convertible to permanent insurance.
And that means
only. Permanent insurance only. They will not allow you to convert to other term insurance. And you read the conversion privileges, go and look at it, verify it with yourself, always look at it, show the client the conversion privileges. It'll say, you know, for a permanent life insurance policy, sometimes it'll say things like to any policy available as determined by us besides term insurance, cannot do term insurance. Okay. Well, the problem is if the renewal is term insurance and the term insurance is 10 or 15 or 20 times more expensive. What's the conversion to permanent insurance going to be? It's going to be even more expensive, right? Maybe 30, 40, 50 times as expensive. So nobody's going to do that, right? The third option is you take another health test, try to get new term insurance. The problem is you're 20 years older. Who knows what's happened to your health? You're going to pay more because you're older. Obviously, a lot of people are not able, as life goes on, to continue to prove into the premium rate classes that they had before. So now they're not only older, but they're getting, you know, substandard ratings, or they're moving from a preferred to a standard rating, and sometimes they become uninsurable. So I want you to understand this and look at this graphic, because this is not how people's need for life insurance works. People's need for life insurance does something like that. Right? It's a theory of decreasing responsibility. Today, a high need for life insurance, eventually a low need for life insurance, right? If here's an asset column down here, right? Today it's low, but over time, the asset column's gonna go up, right? You've seen this 1,000 times. But in practice, term insurance after time one virtually never gets the client, not never, but virtually never gets the client to the point where they are self-insured. We know the statistics in the United States and in Canada today, right? Savings rates are near all-time lows. People do not have enough money statistically to retire, you know, in their 50s and 60s like they used to be able to. People are having to work. They're carrying debt loads longer. They have not saved enough. They need more money than ever saved. You know, so there's a lot of factors that are causing people to need term insurance longer. Okay, so watch this. When you find somebody with term insurance, there's three scenarios. One, you are playing cheaper, right? So they have a 20-year term. They're 2 years in. You show them a 20-year term with us. It's flat out cheaper. Wonderful. Go ahead and do some closing questions, do the close, take the app, no problem, okay? Those are easy. Thank goodness for expensive term insurance companies that are out there, right? Okay, but there's two other scenarios on term insurance where it's not that cut and dry, and you've got to learn how to master this product and be able to master communicating the product to the client, because a client is going to be put in an incredible position by switching their life product over to the Primerica life companies, right? Because of our end of term conversion feature, okay? So two other options, right? Number one, it's cheaper. Number two, it's not cheaper because you're competing at some sort of a disadvantage, right? They had a 20-year policy, they're 3 years in, right? So the 3 good years are gone and you're going in a new 20-year policy. So you're taking them 3 years longer than their original one has. You're trading good years for bad years. It's going to be hard to compete on price, but price is only an issue in the absence of value. And you've got tremendous value that nobody else can give across the kitchen table. And I'm going to explain that to you. So it's not cheaper, okay? But there's a need beyond the term. There's a need beyond the current term. Okay. And the third scenario is it's not cheaper because of whatever factors are being considered. They're older now, et cetera. This is not cheaper in monthly premium. And there's no need for insurance beyond the term. Those are the three scenarios. Okay. So here's how we identify which scenario we're in. Okay. And then let me give you some presentations and some generalities, right? And let me stress to you, you need to read these tables. You need to get very, very familiar with how the conversion tables work to the decreasing term, okay? Because it's different all the time. It's dependent on their age when they convert. It's depending on the health class they had. It's depending on the total face value they had for the original policy. There's some factors that make things different. So I'm going to speak in generalities, but you're going to get the concept and you're going to get the power and value of this product here, okay? So again, here's term insurance in general, right? Time, dollars, here's the $1 million, 10 years, 20 years, 30 years, 40 years. Okay, so what I do, say we're dealing with a client, 20-year term, $1 million face value. They're 3 years in, okay? So they got a 20-year term with company ABC, $1 million face value, 3 years in. So they have 17 years left, okay? It's not 20 years left, 17 years left. I ask them this, I say, Bob and Susan, let me ask you a question. Your policy is going to come up in 17 years. Can you tell me today, beyond a shadow of a doubt, absolute certainty, that you're not going to need $1 of this life insurance in 17 years? Okay, let me say that again. Bob and Susan, can you tell me today, beyond a shadow of a doubt, 100% absolute certainty, that in 17 years, you're not going to need $1 of this life insurance? That is a $1 million question, guys. Okay, you get that down. You ask that every time you come across a term that price to price, you're playing a different ball game because of the feature of the policy and how long it's been enforced. Okay, this is going to help you help a lot of people. It's going to help you help yourself in creating, the ability to help more people move forward. Okay, so virtually always, the answer to that question is no. Right? The answer to that question is no. In 17 years, I'm not totally certain that I'm not going to need any insurance. If the answer to that question is no, guys, the sale is done. The sale is made right there. If you can explain what I'm going to show you, sale's done. Price doesn't matter. Guys, I've helped clients where the current premium prices are many percentages more than they're currently paying, but it's going to save them enormous amounts of money over the total amount of time they're going to need life insurance. So here's what I do. I say, great. So Bob, let me draw you a picture real quick of how your policy is working for all practical intents and purposes, right? So, here's your $1 million, and it's going to be there for the next 17 years. And then 17 years from now, it goes away. It doesn't just go away, but like I just showed you in your policy, right? So I show them the renewal rate, and I ask them, are you going to pay this? Right? So it's $1,000 a year now. It goes to $13,000 a year, right? So it went from $1,000 a year to $1,000 a month. I ask him, are you going to pay this? And his answer is going to be no. No, I'm not going to pay it. Great. But you told me you're going to need some coverage probably beyond that time, right? Right. Okay. Well, then the policy that you have is not going to work for you. You'd agree with that, right? Because for 17 years, you're good, but then you're not going to be able to keep this, right? Okay. So let me ask you this, Bob. What if I were able to get you a policy that did something like this? Let's say it gave you the same $1 million and it even gave it to you a couple years longer than you have it. But at the end, instead of just going away completely, it went down pretty substantially. Okay. And this is just a generality. We'll go through your specifics. Okay. It went down substantially, but then went down little by little every year until you were 100, at which point it'd be worth 0, right? Because your need for insurance is kind of looking like this, right? You said, I'm still going to probably need some at the end. Okay. And your policy doesn't give you that feature. So what if we could extend it a little bit, but not only extend it, we could let you keep a relatively substantial amount of coverage, Bob, with no health check at this point and no increases in premium. If we could do that, that would solve the problem of your policy going up to $1,000 a month. Wouldn't you agree? Great. Because we can do that for you. Obviously, you got to get qualified for it, but if we can issue it, that's what it's going to look like. Okay, great. So this scenario that I'm showing you is what is called our conversion or exchange to decreasing term to 100. So I'm going to encourage you to go into our policies to exchange section 5 on virtually all of our policies. It's found on page 7, okay? And I want you to read it. And what it says is it says that you can exchange this policy at any time after it's been in force for 5 years to the annually increasing premium term insurance to age 100 or to the decreasing term insurance to age 100 plan described below. If the exchange is for the same class of insurance, we will not require evidence of insurability. Okay, I have this memorized. I can visualize this paragraph as I'm reading it. What does this mean? What does this gobbledygook mean? It means the difference of having insurance in later years and not having insurance in later years for the client. Because on any other term product, they will not allow them to do this. So what this means in practice, okay, we're not going to talk about the increasing premium term. There's not a big use for that. But the decreasing term is totally in alignment with our philosophy of theory of decreasing responsibility and the fact that most people are not going to be able to be totally independent of term insurance after their first term. So what Primerica says is regardless of your health, you could be uninsurable anywhere else, have a heart attack, stroke, nobody will give you insurance for any money. Primerica doesn't care. At the end of your term, we're going to give you another term product in the same class of insurance, same health class that you had before. Okay, and the way the decreasing term works, it's a function of $100 of basic annual premium. It means if they're paying $1,000 now, they will have a choice at the end to keep paying $1,000 a year, okay? And that $1,000 a year will buy them a certain amount of coverage in that year, right? Depending on their face value when they first got the policy, their health rating, and the age they are when they convert it. But guys, listen, nobody else out there is allowing people to keep term insurance without a health check at the same price they had before. Granted, they're getting less, but they need less. So you went from taking a client that, said they had a heart attack here. When they get to that 17-year period on that original term policy, they're out of luck. They're not going to have insurance is what's going to happen. And this need here is going to go unfulfilled. But with Primerica, not only in this case would we be able to expand it out some, right? But we'd be able to continue meeting that need, although lower, with no health check, no increase in premium. Nobody is making that promise across the kitchen table besides Primerica. When you really understand the impact that clause has to a client and their future need for insurance, you will be as sold as I am that this is the right product for the consumer. It gives the consumer choice and control at the end of term that they have nowhere else. Everywhere else, they're at the mercy of their health. They're not healthy, they're not getting insurance. Okay, here, that's off the table. We guarantee you the same rating class to a decreasing term. Here's the other cool thing. You can actually buy this up. So now let me talk to you as an agent so you understand exactly how this works and then can convey it to the client, right? So I'm not saying this specifically to the client, but I want you to understand it. So let's say on this $1 million policy, the decreasing term conversion for this specific client went down to 200,000. You might say, well, that's a lot of drop from $1 million to 200,000. Well, go and read those tables. Sometimes your million becomes 940,000. If you're in a certain demographic and you had a 10-year term and you were 30 years old and you were preferred, okay? And sometimes it drops down to 10 or 12% of the coverage and everywhere in between. So you need to get familiar with how the conversions work. But here's the end all be all of this. In this case, drops to 200,000. Well, that's not very much. Remember, they're 20 years older. They have 20 years less debt. They have 20 years more saved. Their children have grown by 20 years. That's unavoidable. That has happened. They need less insurance, theoretically, than they needed 20 years ago, right? They're still going to need some, okay? And remember this, they had a heart attack over at this point. They're not getting a nickel of insurance for any amount of money from anybody, right? Okay, on a new issue. And so they're thankful to have that. But what if you wanted more than the 200,000 in that case? Believe it or not, with the Custom Advantage product, you can buy that decreasing term conversion up. So you're paying $1,000 and it gave you 200 grand. Well, theoretically, you would be able to double it, say, you know what, I want 400 grand. Okay, well, then your premium went from 1,000 to 2,000 a year, but it didn't go to 30,000 a year or 10,000 a year. It was manageable. The client has control and choice. And control and choice are two of the most important things when it comes to people's finances, right? So this is how you explain the value of the decreasing term. And remember, the $1 million question, are you able to tell me today with 100% certainty, beyond a shadow of a doubt, that you're not going to need $1 of this life insurance in so many years? And the answer to that is no. The sale is made because this product simply meets the client's needs better, gives them flexibility into an unknown future more than any other product that is available in the marketplace. So now let's talk about what I think is the most complex piece of this. It is also one of the least used, but you need to know it because when you use them, they tend to be big policies. Okay, so you got to get this. Our product is called Custom Advantage. Believe it or not, it's not just a nice name. Okay, it actually has a custom advantage. So here's the other scenario, right? So here's our time again, our dollars, $1 million, 20-year term. So here's 10 years, 20 years, 30 years, 40 years. Let's do the same scenario. $1 million face value, 20-year policy, 3 years in, which means they got 17 years left. And you ask that client, Mr. or Mrs. Client, Are you able to tell me today with 100% certainty, beyond a shadow of a doubt, that in 17 years, when this policy's up, you're not going to need any life insurance whatsoever? And they look back at you, say, yeah, I'm positive. I'm not going to need insurance. I'm going to be self-insured. You're probably dealing with somebody who's done very well financially. They probably have quite a bit of investable assets out there that you can get. Okay. And you have the ability to make a big difference for these people. So let me explain this to you. So here's what I say. I say, Mr. and Mrs. Client, let me kind of explain to you what's going on. And then let me show you how I think we can provide some value to you. So Mr. and Mrs. Client, for all practical intents and purposes, this is how your policy is going to work. For the next 17 years, you have $1 million in coverage. And then in 17 years, when it's ready to go away, you're telling me I'm going to be totally okay with it going away, right? That's what you've told me. Correct. Okay. So let me ask you this. What you're saying is in 17 years, I'm not going to need any life insurance, right? Okay. Well, if in year 17, you needed 0 life insurance, Mr. and Mrs. Client, in year 16, day 364, so the day before, you needed 0. Did you need $1 million of life insurance the very day before? Probably not, right? If you needed 0, the day before, you probably needed $5 or 10, but you didn't need $1 million. Your insurance need didn't go from $1 million to 0 overnight, right? Unless you win the lottery, right? What's happening, Mr. and Mrs. Client, is your insurance need is kind of doing this, right? That's what you're telling me. I'm going to be self-insured. I'm going to need less and less until I get there, and then I'm going to need 0, right? Okay, very good. Well, right now, you have a policy that's kind of like an off-the-rack suit, so to speak, kind of one size fits all. You bought it for 20 years. You said at the end of 20 years, I'm not going to need it. But in practice, what's happening is, you need all of it now, but you're going to need less and less as time goes on. So you see this coverage over here that you purchased it, you're paying for, but what you're telling me is I don't really need it. It's extra, right? So Mr. and Mrs. Client, let me ask you a question. Do you enjoy paying for insurance that you don't need? No, of course not. Nobody does, right? So what if I was able to build you a policy, a custom policy designed for you, not off the rack, that more accurately mimicked your need for life insurance and cost you less money than you were paying now for it? So if it more accurately followed that and it costs you less, is there any reason you would want to continue overpaying for insurance you don't need? That is $1 million question there, folks, okay? Because nobody's going to say yes. Yes, I would like to continue to be overcharged paying for insurance I don't need, right? Of course they want to pay less. But you've got to qualify. If I was able to get you a policy that more accurately mimicked your stated need for life insurance and it cost you less, would you go forward with something like that? All right, and then here's how you do it. You can build a custom plan. So you have a base plan, okay? And then you can add riders with our policy. So let me show you how I would solve this problem, okay? I do $1 million total face value, right? And I'd break it up like this: $500K on our 10-year term base plan, okay? $250K on a 15-year and $250K on a 20-year. The reason you can't just go and show him a new 20-year is it's way more expensive, right? And he doesn't need it. So you're not going to win on that. So remember this scenario. He's got term, you're more expensive because he's 3 years in, and he says, I don't need it at the end of time, right? So what happens here is for the first 10 years, all 3 of these pieces are together. So the total face value is the sum of them, $1 million, okay? So for the next 10 years, the policy is $1 million. At this point, in the 11th year, this piece of it will come to the end of term and can convert, okay, to the decreasing term. So that piece will drop pretty substantially, right? And then it will start going down little by little every year, okay? At which point you get to year 15. This piece goes to convert to decreasing term. So another little drop, and then begins to go down again, right? In year 20, this piece will begin to drop and then go down again. So the product that we built kind of looks like a sloped staircase, right? And again, this is a generality. It's going to be different for every client, but it's going to look the same. The question is, where does the slope staircase start and how quickly does it slope? And that's going to be dependent on their specifics, right? But in generality, that's how this is going to work. So what's happening here is you cut out all this excess and you're cheaper than their 20-year term because it's not a 20-year term. It's a hybrid policy. It's literally a custom policy that you've built. And you can do all sorts of crazy stuff with this. You could choose to get rid of the 15 when it came and just drop it and the premium drops. You can choose to convert them. You can choose to keep them level. I mean, there's so many choices and you don't need to choose today. You can choose then when we see what the client scenario actually looks like. But the flexibility here is unbelievable, right? And you come in maybe at 60, 70% of their current pricing, right? Okay, so not only did you give them a policy that more accurately mimics their current need, but you got them covered if they're wrong by having the ability to keep that decreasing tail further out, and you're saving them money. It is a win-win-win. Nobody else creates products like this. Nobody else has the ability to, right? Because even if they could stack riders on, which most of these guys do not have provision to be able to do that, okay, but even if these other companies could stack riders on, their rider would go away. So instead of having this nice little flow, it would go boom, 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 right? And it would not accurately mimic their need for insurance. Okay, so folks, this is how you win with term insurance. All right, there's no term insurance out there, in my opinion, all right, and in my experience, that's going to put the consumer in a better position, give them more control, more choice, more flexibility, and more peace of mind than having life insurance through the Primerica companies. It's just not out there. You need to learn this and understand it and learn how to communicate it to people. Because when people understand it, like you understand it, it's just common sense. People want to do the right thing. They just don't understand, and they don't know how their policy works. So we've got to show them how their policy works and show them a difference. But it's not price, you guys. If you're competing on price, you're in the wrong ballgame, right? Price is only an issue in the absence of value. So let's move on now to the closing questions and the close. So now here's the second part. So remember, we would do presentation, and then on the back of the presentation, we'd add on a series of fixed closing questions and a fixed close. So the closing questions and close were the same, the presentations were different. So you can apply these closing questions to the end of every one of the presentations. So you've done the presentation, you said, does this make sense why you need to do this, okay? Now, on the term insurance ones where you've got face amounts that are already set, you really don't need to do this, okay? But on the people that have no insurance, the people that have group insurance, it's imperative that you ask these questions. This is how you move the transaction along. So group insurance, no insurance, whatever it is, we've established the need. So you understand why this makes sense, right? So Mr. and Mrs. Client, Bob and Susan, let me ask you a couple of questions. Question number one is this, okay? If money weren't an issue, how much coverage would you want your family to have? That's it. If money weren't an issue, how much coverage would you want your family to have? And I let them answer. Most of the time, the client will give you an answer that's in the ballpark. Now, if the client's living in a $300,000 house, he says $50,000, you might need to stop and back up and give him a little bit of an explanation of what life insurance is for. It's income replacement, right? Okay. But by and large, they're going to give you the right answers. Let's say the client says $500,000. Say, okay, so $500,000 is what you'd like to have if money was not an issue, right? So Mr. and Mrs. Client, listen, the next question, money is always a concern when it comes to these things, right? You'd agree. How much do you feel that you could put towards on a monthly basis? How much do you feel like you put there monthly comfortably towards making sure that your family was properly covered? Most of our clients, before you answer that, Mr. and Mrs. Client, say somewhere between $50 and $100 a month. Some of them say even more than that, okay? Some of them say as little as maybe $30 or $40 a month. Mr. and Mrs. Client, where do you feel like you could comfortably be? In 6 months, you're not thinking, gosh, yeah, we could definitely do that. And I get an answer. And virtually always they pick what? 50 to 100 a month, which now again, talking to you as an agent, you're sitting there with a 60-year-old smoker who is living in a $5 million home. He's talking to you about a $3 million policy. You shouldn't talk about $50 to $100. You got to kind of know the ballpark, but that's called framing. All I'm doing is I'm setting an expectation of where that premium is probably going to be. And I let them pick. Remember from earlier, when you say it, they doubt every word. When they say it, it's 100% true.
Yep.
So when they tell you what they can afford, you're never going to have a money issue. When you tell them what they should be affording, you're going to get some resistance from time to time, right? So again, the two questions are, if Mr. and Mrs. Client, if money wasn't an issue, how much coverage would you like to have for your family? And my next question, Mr. and Mrs. Client, obviously money is always a concern. How much do you feel like you could put towards this on a monthly basis that you would be comfortable with to make sure that your family was well protected? Most of our clients, before you answer that, will say somewhere between $50 and $100 a month. Some of them say even more than that. And some say as little as 30 or 40 a month. Where do you feel like you could comfortably be? And I write down the numbers. They say, well, probably between 50 and 100. Okay, great. More on the higher end, more on the lower end. Well, probably, more on the higher end. Okay, so, we definitely don't want to go over 100, but we want to keep it below that, right? Very good. And what I do is I go into Quick Quote and I create a product that works in this scenario, which again is why you need to learn how to frame it appropriately. You can't say, you do it for $30 a month on $1 million and they're standard and 55 years old, right? So you got to be making sure that you're in the ballpark so that when the numbers you're showing them come back, they're in the range. Okay, so that's the two closing questions. So here's the close. And again, it's really not a close, it's information. People that are empowered consumers make good choices. The end of the story, people in America are very intelligent. They want to do the right thing. They just don't know where to begin. Nobody's ever told them. They don't know who to trust. And they've never educated them. So here's what we're going to say. So let me give you a couple of nuances here. Let me give you some qualifiers before we go through this. Many states have different free look periods. Okay? The state of Michigan, where most of my business is a 20-day free look. But you need to use the free look period in this example that is in your state. Okay? Otherwise, you're going to give them some wrong information. That's number one. Number two is on Term Now. Okay, that's an instant issue product. Some of the time frames here are going to be a little more condensed than what I'm explaining to them. Okay, so you need to make sure that if you're quoting them Term Now because you just did the quote. So it's Term Now, you got to adjust the time frames in here. But this is how I explain the process to the client. Okay. So I say, Mr. and Mrs. Client, before we start, 100% assumptive. So we've gone through the presentation. We've told them the reasons why. We've gotten buy-in that, yeah, that makes sense. We've gotten an expectation set. I want this much coverage for around this much. We've showed them numbers that work. Here's the assumptive close. Mr. and Mrs. Client, what we're going to do today is we're going to file an application. With that application, we're going to put a 1 month's premium on a deposit. Okay. Let's call it $75. It's going to go in with the application. It's just going to sit. There'll be no more premiums withdrawn unless you put this policy in force, like a good faith deposit. Okay. From today forward, all right, we will begin covering you for free conditionally for the next 30 to 60 days for up to a maximum of $500,000 each. You're applying for $1 million, we're not going to cover you for that. Okay, but $500,000 each. Okay, that coverage is going to start today, and I'm going to explain a couple of things to you here about that in a second. Okay, but during the next 30 to 60 days, I'm going to need you guys to do two things for me. One is I'm going to need you to do a telephone interview where they're going to call you and ask you the same medical questions that I ask you to do. So I need you to make sure that you tell me things exactly as they are, okay? No hiding stuff. If you're concerned, tell me. My job as an agent is to help you navigate and make sure that you've recorded these things accurately, okay? So you don't have problems later on. Number two is you're going to do a paramed exam. Blood, urine, vitals, maybe a resting EKG or a full EKG. It will be paid for. They'll come to you. You can go to them. It's really flexible. Now, what I need you guys to do is I really need you to do this virtually immediately. I'll tell you why in a minute, okay? But those are the things we're going to need to do. Now, about 30 to 60 days from now, Mr. and Mrs. Client, we're going to get a physical policy back, okay? Once we get that policy back, I'm going to come back and we're going to go through it, okay? And again, in Michigan, we're going to start what's called a 20-day free look period. So in that 20 days, Mr. and Mrs. Client, you guys have three choices. Choice number one is you can say no, thank you. Okay, well, why would you do that? There are situations from time to time where the company declines coverage. They say, based on how, we're not going to offer it to you. Or sometimes they come back and because of this or this or this, the coverage offer is much, much more expensive than we initially thought. So the moral of the story is if something comes back and it's just not something we can work around, you do have the ability to not move forward with it. If you choose to do that, the money that's sitting on this deposit will be refunded to you in full. So Mr. and Mrs. Client, I just need you to understand, there's no risk to going through this process. Okay, it doesn't hurt you to try this. Okay. The second thing that's also unlikely, but more likely than this, is that it comes back potentially slightly different, maybe considerably different than I've shown you. Okay. As much as I'm going to do my best to guide you the right way, I'm not an underwriter. Okay. And I'm not going to make those final decisions. So it may come back and we may want to make some changes. We can increase it, we can decrease it, we can change the term length around within that 20 days, no issue. So if it comes back as a little bit different, we can make changes. Okay, so we're not set in stone today on what we're applying for. Okay, we'll be able to make some choices once we really see what it is. Okay, Mr. and Mrs. Client, the third option, this is probably what's going to happen. It's going to come back exactly like I've shown you. Okay, and you're going to say, this is good, this is exactly what we've talked about, I want to keep it. So at that point, you're going to sign the policy into effect. The money that's on deposit is going to come out, and it's going to pay 1 month forward. Okay. So let's say it's the month of March, hypothetically right now. Okay. So Mr. and Mrs. Client, March and potentially some of April, depending on how long it takes you to get underwritten. Okay. But let's just call it March. March, you're going to be covered for free for this conditional coverage amount. April rolls around, the policy issues. April will be paid for, Mr. and Mrs. Client, by what? I circle it. I make sure they understand from the deposit. Okay. This ensures the client understands that there's going to be money coming out of the account right now. And they understand. It ensures they understand what's going to happen with it, right? It's either going to go back or it's going to apply to the premium. So sometime in May, in this example, you'd start paying your premium. So Mr. and Mrs. Client, what I'm going to need from you is just your driver's license. And I'm going to start asking you some questions. So if you get that for me, that'd be great. And that's it. People are afraid of making a bad choice. This educates them in great detail on exactly what process they're going to go through, the time frames, sets their expectations, lets them know their opportunities at the end. And it sets the expectation that if things don't come back as we want them to come back, that we're not stuck into something here, that we can work together. It sets a stage for a great relationship. So I start taking the application, okay, and here's where I go back to this, and I explain conditional coverage, because there are many that don't understand conditional coverage the way that it needs to be understood. Conditional coverage on a Primerica policy, okay, through any of the Primerica companies, MBL in New York, Primerica Life, and the rest of the country, they don't understand how it works. It sort of turns on and off throughout the interim, right? As soon as there's a requirement, as soon as a medical requirement's issued and it's not done, that coverage shuts off. So when I'm typing it in, I say, Mr. and Mrs. Client, remember I told you you're going to need to do the telephone interview and the paramed exam, right? Here's what I need you to do. They're going to call you over the next couple of days, okay? And I need you to promise me that you will get that call returned as soon as possible. Now, listen, if you're at work or something you can't pick up, that's fine, but I need you to promise me that you're going to return that call immediately, because as soon as they have a requirement for that and it doesn't get done, they're going to shut down that free coverage temporarily. Okay. Now, as soon as you do it and you comply with it, you're good, right? They do the paramed testing, right? They schedule, it's not done, you're not covered. Now, as soon as it's done, that coverage turns back on. So what I want to do is I want to eliminate down to an absolute minimum the amount of time that coverage is off. Okay. So it should, if you get it done quickly, it'll be on virtually the majority of the time. But if you don't, then you might be in this little bit of a gray area. And again, I'm doing this while I'm taking the app. I've explained to them what's necessary, and now I'm reiterating, right? I'm essentially post-closing them on making sure they quickly do the paramed and quickly do the telephone underwriting, right? And that helps you get the policy issued quickly, helps you eliminate not take-ins. It's really a powerful thing, okay? So the last thing we're going to talk about is really a 4-step process to overcoming objections, okay? And, Hector's got incredible things. Keith Otto has incredible things. You guys are great at overcoming objections. But I'm going to teach you my process on overcoming objections on people who have no life insurance or only group insurance, which is essentially having no life insurance, no private life insurance anyways, right? Okay. People who have life insurance, they're going to have different objections. I want to talk to my value on is people who don't have coverage. So always remember this. People that don't have life insurance, that need to have life insurance, have a habit of making poor financial choices. That's why they're sitting in front of you with their family completely unprotected. Never forget that. Because if you leave them and you're a positive influence, and for 20, 30, 40 years of their life, they haven't gotten around to protecting their family, what do you think they're going to do when you leave?
All right, guys. So I shared a lot to you about getting term insurance with us. And he just explained the procedure of how life insurance work. And when you get in the details and how it the process of getting it, and she showed some complex scenarios of people who already have permanent insurance and their age and how far along they are. He shared how they can it's the complication of adjusting to term insurance. So it's a lot packed in there, and but there's the basic way of getting life insurance, and as I'm sure a lot of people already know, it's better to get it when you're younger because the premium depends on your age. The younger you are, it's the more affordable it is. All right. So, all right. So I have 9 minutes leave before I end the live. So let him continue. Yeah, let him continue with the rest.
Right? They're going to do more of the same. You have one shot with these people to help them protect their family. It's literally life or death financially for this family. Okay. So you got to be prepared to help them understand the value and the reasons why. So remember this, most of the time, objections around people that don't have life insurance, only have group, are really stall objections. They're not objections. They know they need to do it. But again, they're just scared to commit. They're scared to take action.
Mm-hmm.
They don't really see the value, whatever it is. It's a stall objection. It's usually like, well, we just need to think about it. Can we do this at another time?
I get a
We
lot
don't
of
make
that.
decisions on the same day. And so you got to be ready for that. 3-step process to overcoming every objection. Number 1, affirm them. Okay. Nobody wants to be argued with. What do you mean you need to think about it? Right? Okay. Affirm them. Mr. and Mrs. Client. Wow. I really appreciate you for saying that. I'm the same way. I don't like to make decisions right away either. Okay. The great news
Nobody
is
does.
today's not decision day. All we're doing, and we're back to that A diagram, all we're doing, I circle it, is applying today, right? And we're going to get underwritten. We're going to get a policy issued. Okay. So we're just starting the process on this now. When it comes back and it's good, I know you want to take care of your family. We're going to make sure that this gets placed. But, today is not decision day. We're not deciding on anything final. We're just starting the process. We're getting ourselves something to even make a decision on. Does that make sense, Mr. and Mrs. Client? Great. Let me grab your driver's license and let's get started. So that's objection 1. Today's not decision day. Objection 2. So you give them overcoming objection number 1. Today's not decision day. And they say some version of the same thing back to you, right? Because again, it's a stall. Yeah, I understand that. But, we just, we made a pact that we would never make a big decision on the same day without sleeping on it. Yeah, right. They've got a massive TV there. They have no life insurance, no savings. They got 2 nice cars in the driveway. They make decisions every day that are detrimental to their finances without thinking about it. But you're asking them to take responsibility. That's a defense mechanism that they have there, right? So you need to understand that. You say, hey, again, man, thank you for saying that. I really, really appreciate it. That's a very admirable trait. But let me ask you this. I call this the college close. Have you ever been to college They're either going to say yes or no. They say no, then you say, you know anybody that's ever been to college? Sooner or later, they're going to answer that yes. But one of them generally will say yes. Yeah, I've been to college. I say, great. Where did you go? Well, I went to the University of Michigan. Awesome. Very good. What did you study there? Great. Hey, listen, think about it like this. When you applied to the University of Michigan, did they have to let you in?
Nope.
And they think about it and say, well, no. So that's kind of like this. We can apply, but it doesn't guarantee us that we can get in. Now, when you got accepted to U of M, did you have to go there? They think about it and say, well, no. I say, you're right. You could have gone somewhere else, not at all. Right? It's your choice. It's the same way here. Once we give you an approval, then you can make your final decision. But let me ask you this question. Would it make sense to move to Ann Arbor, which is where U of M is, buy a condo, get a bunch of U of M clothes, tattoo U of M on your forearm before you apply to U of M? Would it make any sense to do that?
People do.
Right. That's kind of like putting the cart before the horse, right? You're putting effort out and doing things, but you don't even know if you can get in or even what the offer is going to be, right?
But they still do it.
So you would apply, get in, and then once you decided that's where you're going, then you would start making some changes around that, right? Okay, very good. Well, this is the same process.
Yeah.
What you're telling me is, I want to think about it, I want to do all these things before I even know if I'm going to be offered this, right? So let's apply, let's get you an offer, and then let's make some decisions then. Because right now, there's nothing to think about or to decide. We have 100% of the available information. Okay, so let's go ahead and get that started. And let's get some more information, a solid offer. We'll make some decisions then. Okay, great. So the third close is, they say, oh, yeah, I understand that. But, I'm not, I just still don't want to, really move forward today on that. Okay, so at this point, you're moving out of logic and into emotion. Those first two overcoming objections were complete logic. Here's the order in which things happen. There's no risk. Let's get you started. Now you're going to move into emotion, which is where this client is. They're not making logical, rational decisions. They're making emotional decisions. That's okay. So you want to talk to them in the language in which they're communicating to you. Okay. So here's what I say. I listen and I say, wow, that's great. You guys really do feel strongly about that. And you know what I like? I like meeting people that have a lot of conviction about what they believe. But if it's okay, let me ask you a question. But before I do, I just want you to understand really quick. I don't want you to feel like I'm being pushy with you at all, because that's the last thing I would want you to feel like, okay? And that's not my intention at all. I'm just doing my job and trying to explain to you something, because I know if you knew what I knew, I know that you'd be going forward with this, right? So again, please don't feel that way. So I just qualify that, right? Because when you start asking them questions that get them emotionally engaged, that's a very powerful way of communicating to people. The problem is sometimes you get some very powerful responses, right? Because you're engaging them at a level that's a little different. So you've got to qualify that. And if you qualify it with and say, listen, I just want you, before I ask you this, I just want you to understand I'm not trying to be pushy with you at all. That's the last thing I would want to do, okay? I'm just trying to help you understand something, okay? And generally they're like, oh, okay, great. And it disarms them. I'd say, so Mr. and Mrs. Client, and I draw this picture. This is called the A-B close. Mr. and Mrs. Client, okay? What I'm hearing you say, correct me if I'm wrong, what I'm hearing you say is, I just want some time to be able to think this through, right? That's what you're saying to me, right? Okay, great. So either way, right, whether we apply today or don't apply today, either way, what you're telling me is I'm going to think about it, right? Okay, great. And either way, whether we apply today or not, the cost is free, right? Okay, you got to put a deposit down, but if you didn't go forward with it, you get it back. So it didn't actually cost you anything. It's a deposit, right? So either way, it's free, right? Whether we applied or didn't apply, either way, it was free, right? Okay, good. But in way A, when we apply today, your family is going to start being covered for up to, right now, again, if they only apply for 200,000, you write 200,000. They apply for $1 million, the maximum conditional coverage is 500,000. Mr. and Mrs. Client, they will start covering your family for $500,000 while you're thinking about it. Okay, you got to do your underwriting and different things, but we're going to start covering you today doing this.
Yeah. Even
thinking about it and not filing an application, your family's going to be covered for zero. Mr. and Mrs. Client, let me ask you a question. Which way,
even when the policy has an issue,
better protects your family while you're thinking about it? Guys, people know that what we do is so important. They know they need to do it. They're trying to get out of taking responsibility. But at that point, generally, they get a little smirk and they're like, all right, let's go forward, right? Because you've shown them why this makes sense, okay? At this rate, I would say 80 to 85% of the people that you sat with, that you've gone through this, are going to be moving forward with you, okay? There's a straggler little percentage that says, yeah, I understand that, but I'm just not going to move forward on anything. I decided before you got here, no matter what you said, I wasn't going to move forward. Okay, so what do? You affirm, right? I appreciate that. You answer, and then you ask them to move forward. 3 steps to overcoming an objection: affirm, answer, close, right? Okay, so close number 4 is what I call the next door neighbor. So what I do is I close up my stuff. I sit back in my chair a little bit. I lower the tone of my voice. I say, Mr. and Mrs. Client, I really appreciate you having me over. And I'm sorry that I haven't been able to convey to you, for whatever reason, the importance, because I know how much you care about your family. But before I go, let me just ask you one more question. let's pretend, the neighbor down your street, 4 or 5 houses down, and, similar age to you guys, similar amount of kids, same socioeconomic status. Not you, right? Not you, of course, but your neighbor 4 or 5 houses down. And I was there, I was talking about it. They were telling me, no, I just need to think about it. I'm not going to do it today. And so I left, and, they didn't move forward. And it's not you, this is your neighbor, but God forbid, a month later, they pass away, and you're at the funeral, I'm at the funeral, and it's just a tragedy. It's a tragedy, right? And there's 300-400 people there at that funeral home. And at some point, something's going to come across every one of those people's minds. And they're going to think, I wonder if that family had what? And I let them answer. Because remember, when they say it, it's 100% true. They say, well, life insurance. Say, well, if every single person there thought it was a big deal, it's probably a big deal, right? Wouldn't you agree? But that's not really my point, Mr. and Mrs. Client. Imagine I was there at that funeral home, and that widow's father found out, right? So it's grandpa, daughter's all alone now, trying to raise 2 kids, no money. And that woman's father found out I was at their house. And for a refundable deposit of $70, we'd have been paying her $500,000. And he found out I didn't ask him one more time. He'd come up to me, and what do you think he'd say? He'd say, why didn't you ask them again? Why didn't you pull up a tent in their living room and sleep there until they left? Why did you leave? Why didn't you take the pen, put it in his hand, and tell him sign? Because my daughter is going to have problems for the rest of her life. That's what that man would be saying to me. Imagine if he told the other people there. He'd be chasing after me with baseball bat. What do you mean you left? What do you mean you were okay telling him, sure, you could think about, why didn't you make him do this? That's what every single one of them would be saying to me. I think you and I both know this is something you should do. Why don't we go ahead and get you started, right? This is the right thing for you. And I asked them to go forward one more time. If at that point they will not move forward, I'm done. And I respectfully thank them for their time. Tell them how glad I was to make their acquaintance. I hope that at some point they change their mind, even if it's not with me. I hope at some point that you do this because it's important for your family. I shake their hand, and I leave on a positive note. I don't want people to feel badly about their interaction with us. I want to be able to say what's necessary for those kids and that spouse, right? But I don't want them to feel badly. We want to be professionals at the kitchen table. We want people to think, that when I leave, I want them to think that was somebody who really believed in what they were telling me, right? And we have a responsibility to our clients to help them move forward, a moral obligation. If we can't help them move forward, guys, we're not helping them. At some point, they're going to have a ticking time bomb, so to speak, on their life insurance policy. At some point, it's coming up, and it's not going to be pretty unless they have something through one of the Primerica companies. I hope you've gotten a lot out of this. I hope you listen to this over and over and over again until you can draw it out, until you can speak it, use the same verbiage. And I know that it's going to help you immensely. It's going to help a lot of clients get the protection they need with an incredible company. Thanks, guys, for listening. Until next time, we'll see you again.
All right, guys. I hope you learn a lot from that. That was good. And he unpacked a lot of information that I couldn't share with you. So I hope you really enjoy it. And yes. All right, guys. So we come to the end of the stream. So thanks for watching, and I hope you enjoy. Once again, don't forget to like and subscribe. All right. Thanks again. Have a good day.